Welcome back to the Deep Dive. Our mission here is to take stacks of complex source material historical documents, regulatory filings, financial data, and really turn them into the deep insights you need to be truly well-informed.
And when we talk about, financial stability and making sure your money is safe in the United States, one name always comes up.
The FDIC, the Federal Deposit Insurance Corporation, they're the ones everyone knows. They back the big commercial banks.
Exactly. And that familiarity, it's well earned, but it kind of obscures a huge part of the picture. The U.S. financial system has this crucial parallel structure, the credit union movement.
Right. And if you, the listener, are one of the, 124 million people in this country with an account at a credit union,
That's a number.
then you are insured and regulated by a completely separate, equally vital, and frankly, a much less understood federal agency. And that's our entire focus today. We're zeroing in on this powerful regulator, the National Credit Union Administration, or as we'll call it, the NCUA.
It's the sister agency to the FDIC, but it is built exclusively for credit unions and their unique cooperative nonprofit structure.
So let's define it right out of the gate. What is the NCUA, fundamentally?
Okay, so at its core, it's an independent U.S. federal agency. Congress created it, and it has this really expansive mandate to regulate, to charter, to supervise, and this is the most critical part for most people,
Yeah.
to ensure the nation's credit unions.
And that structure, it seems to suggest that credit unions are just different. They need their own special kind of oversight.
They absolutely do.
Yeah.
The whole idea is that because they're cooperatively owned by their members and they're mission-focused, not profit-focused, they just don't fit the commercial banking regulatory model.
And we are not talking about a small niche player here. The scale is. I mean, the sources we have paint this massive picture of financial responsibility.
It's staggering, really. As of December 2020, you had the NCUA insuring the deposits of over 124 million people
124 million?
across nearly 5,100 federally insured credit unions. And the total assets under their watch. It was over $1.84 trillion.
A trillion with a T. Yeah. That puts the NCUA firmly in the big leagues of financial regulators. They are managing a huge pillar of American finance.
Right. So our deep dives today, our mission is to give you a really comprehensive understanding of this agency. We're going to unpack its unique governance, trace its history all the way back to the New Deal.
And look at how it handled some major financial crises, all while, and this is key, maintaining a cooperative, non-taxpayer-funded insurance system.
Exactly. The goal is for you to walk away truly informed about the other major financial insurer in the U.S.
Okay, let's unpack this, starting with the architecture, the very structure that makes this agency tick. So the first thing that really jumps out at you about the NCUA is its governance. It's not led by a single person like a secretary or an administrator.
Right.
It's run by a 3-member board. Why do they do it that way? It seems very deliberately designed for, stability.
That is the absolute key insight. The board model is all about checks and balances. It's about continuity. These 3 members, they're not just picked out of a hat. They're high-level federal appointees.
Appointed by the president, confirmed by the Senate.
Yes, which just underscores how serious their positions are. I mean, they're trustees of a nearly $2 trillion financial system. The president then picks one of the 3 to be the chairman to, set the agenda.
And what's really fascinating to me is the political constraint that's baked right into the law.
The bipartisan rule.
Exactly. The law says no more than 2 of those 3 members can belong to the same political party. That's not an accident, is it?
Not at all. It's a structural requirement designed to force bipartisanship. It's like an internal break on ideology. A huge policy change or a response to a crisis can't just be pushed through on a narrow party line vote.
So it forces them to talk to each other.
It forces deliberation, negotiation, consensus. You compare that to an agency run by one person who can be swapped out the day a new president takes office. The NCUA's structure is built to prevent that kind of regulatory whiplash.
And the terms they serve, that reinforces the goal too. 6 years.
A long time. It's designed to span across presidential election cycles to provide that stability.
And they can't just keep getting reappointed either.
Right. The rules are pretty specific. You can't be reappointed to succeed yourself immediately unless, say, you were just filling out the last bit of someone else's term. It's meant to encourage a slow, steady rotation of fresh perspectives without, gutting the institution of its experience.
And there's this one little logistical detail, the holdover provision, that seems incredibly important for keeping things running.
Oh, it's essential, especially in today's political world. It means that if a member's 6-year term is up, They don't just pack their bags and leave.
They stay on.
They stay on. They continue to serve until their replacement is not just nominated, but actually confirmed by the Senate and sworn in. This prevents a power vacuum. It means a political fight can't just paralyze the agency.
And we can see this in action. The source material gives us a snapshot, right? As of July 26, 2025.
We can. In that example, the chairman is Kyle S. Hauptman, a Republican. But the other two seats, the vice chair and the member slot, are vacant.
Which happens a lot in government.
All the time.
Yeah.
But because of that holdover rule, the agency doesn't grind to a halt. It can still function. It does, however, show you the vulnerability. I mean, a board that's supposed to be 3 strong and bipartisan isn't at its best when it's operating with just one member for a long time.
Right, makes sense. Okay, so from the leadership at the top, let's go to the boots on the ground. This is a national organization covering all 50 states, territories. How do they manage such a huge supervisory load?
They break it down. The agency operates through 3 big regional offices. And that physical separation is crucial for effective regulation.
Why is that?
Well, think about it. You need examiners to be physically near the institutions they're regulating, especially with that mandatory 12-month examination cycle we're going to talk about. It's all about having that close supervisory relationship.
Okay, so let's lay out these 3 pillars for the listener.
First up is the Eastern region. It's headquartered in Alexandria, Virginia. And as you'd guess, it handles the really dense, established credit union areas in the Northeast and Mid-Atlantic. So you're talking New York, Pennsylvania, Virginia, D.C.
The older, more urban institutions?
Exactly. Then you travel south and you get the Southern region, based out of Austin, Texas. This one covers a huge swath of the country: Florida, Texas, Georgia. And its reach goes into the Caribbean, too, which is an important detail. They oversee credit unions in Puerto Rico and the U.S. Virgin Islands.
And finally, the West.
The vast western region, which is run out of Tempe, Arizona. Geographically, this one is just enormous. It covers everything from the Midwest, like Illinois, all the way west. So you've got huge financial centers like California and Washington, but also Alaska, Hawaii, and even the Pacific territory of Guam.
That division of labor seems so important. It lets them tailor their supervision to what's actually happening in the local economy, right?
It's vital. The health of a credit union is often tied directly to local industries. Is it auto manufacturing in Michigan? Is it tech in California? Tourism in Florida? The regional offices make sure their examiners understand those specific economic headwinds when they walk in the door.
Okay, so let's pivot to what powers all of this: the money. The sources make it really clear that the NCUA isn't just one big pot of insurance money. It's actually 4 separate funds.
Yep, and this complexity is key. Most people only know about the first one.
The insurer, the National Credit Union Share Insurance Fund, or NCUSAF.
That's the one. It's the main guarantee. Insures your deposits up to $250,000, and it is explicitly backed by the full faith and credit of the U.S. government. It is the absolute bedrock of consumer confidence.
Okay, number 2.
The NCUA Operating Fund. This is what pays the agency's bills. It works with the NCUSAF to cover the day-to-day stuff salaries for all those examiners, IT, rent for the regional offices. It keeps the lights on and the regulatory machine running.
The third one seems strategically crucial, especially in a crisis: the Central Liquidity Facility, or CLF.
The CLF is fascinating. It's what really anchors the cooperative independence of the whole system. It's the lender of last resort, but just for credit unions.
So if a credit union has a sudden cash crunch,
A big unexpected wave of withdrawals, maybe, or the money markets freeze up, the CLF can step in and provide short-term loans to tide them over.
how is that different from, say, the Federal Reserve's discount window that banks use?
It's the structure. The CLF is member-owned. Credit unions actually buy stock in it to become members. So when one of them needs liquidity, the CLF is essentially tapping into this shared capital pool to stabilize that institution. It's a critical line of defense. It lets this system solve its own short-term problems internally.
And that brings us to the 4th and final fund, the Community Development Revolving Loan Fund. This one really seems to speak to the mission of credit unions.
It absolutely does. The CDRLLF, as it's called, exists purely for community investment. It provides loans and grants to credit unions that are specifically serving low-income and underserved communities. So the NCUA is using its power to actively foster economic growth, tying regulation directly back to the whole reason credit unions were created in the first place.
To really get the NCUA today, you have to go back, way back. Like so many of our big financial institutions, its story starts in the Great Depression.
That's right. The year is 1934. President Franklin D. Roosevelt signs the Federal Credit Union Act into law. And you have to remember the context. Trust in banks was completely shattered. Millions were out of work.
And the goal of the act was what exactly?
It was profoundly progressive for its time. It was designed to promote thrift, saving, and to create a stable national system of financial institutions that were based on this cooperative nonprofit model.
This idea that the owners are the members.
Exactly. Any profits go back to the members through lower loan rates or higher savings rates. It was a direct contrast to the shareholder-owned, profit-driven banks that had just failed so spectacularly.
So in the beginning, this new regulatory body was pretty small.
Tiny. It started out as the Bureau of Federal Credit Unions, the BFCU,
Mm-hmm.
and for the first few decades, it sort of wandered through the government bureaucracy.
The sources show this crazy migration.
It's a real shuffle. It
Yeah.
started at the Farm Credit Administration.
Yeah.
Then, kind of ironically, it got moved to the FDIC for a while.
The very agency it would later parallel.
Right. Then it went to the Federal Security Agency, and finally it landed for a time inside the Department of Health, Education, and Welfare, HEW.
So you can really think of this period as the agency just trying to find its footing, right? It's always part of something bigger.
Completely. But while the regulator was getting shuffled around, the credit union movement itself was just exploding. By 1960, the scale was becoming undeniable. You had over 6 million members in more than 10,000 federal credit unions. The Bureau was just outgrowing its small corner in the government.
And that growth, that demanded a change.
It demanded independence. It demanded focus. And that really sets the stage for the big turning point in the 1970s.
This is when the BFCU gets a complete overhaul and becomes the modern independent NCUA we know today.
1970 is the year. And just as importantly, 1970 is when the National Credit Union Share Insurance Fund, the NCUA, was formally created. Having federal deposit insurance specifically for credit unions was a huge step.
Okay, and let's focus on the aha moment here, because this one detail seems to define the entire philosophy of the agency, the funding.
This is the fundamental distinction. The NCUA was capitalized solely by credit unions.
No tax dollars.
Not a single cent of taxpayer money was used to start it. And that self-funded model isn't just a fun fact. It creates this perfect alignment of interests. The entire credit union system has a direct financial stake in making sure the insurance fund is stable and well-regulated, because they are the ones who paid for it.
So in the 70s went on, the credit unions themselves were getting more sophisticated.
Much more. By 1977, they weren't just simple savings and loan operations anymore. They were offering things like share certificates, doing mortgage lending. They were becoming the full-service institutions we see today.
And that complexity demanded a more robust leadership.
It did. And the response came in 1979 when that three-member board structure we talked about officially replaced the single administrator. It was about building in that stability at the top.
And 1979 was also the year they formalized the Central Liquidity Facility, the CLF.
Yes. Adding the CLF, that lender of last resort, was Congress recognizing that as these institutions grew, they needed their own dedicated source of liquidity to manage risk. So by the end of the 70s, the picture is complete. You have separate dedicated bodies for regulation, insurance, and liquidity.
And the growth during that decade was just off the charts.
Unbelievable. Membership doubled and assets tripled to over $65 billion. The 1970s was really the decade the NCUA came into its own.
So the NCUA gets its modern independent form just in time to face, what, a massive economic test in the 1980s?
An immediate test. The early 80s were brutal. You had sky-high interest rates, a deep recession, soaring unemployment, and all of that economic stress flowed directly to the credit union system.
And it started causing losses.
Significant insurance losses.
Yeah.
The NCUSF, that fund that was so proudly built by the credit unions, started to feel the strain from all the failures and the payouts.
They had to fix it, but without going to the taxpayers for a bailout.
Right. The solution came in 1985, and it was a crucial recapitalization. The federally insured credit unions all deposited 1% of their total shares directly into the NCUSF.
So it wasn't a fee, it was more like an equity injection.
Exactly. It was an equity deposit that instantly shored up the fund and gave it the cushion it needed to absorb more losses.
And this action, it basically created the fail-safe mechanism that protects the fund to this day.
It did. It's a highly sophisticated system designed to trigger automatically if the fund's capital level drops too low.
What's the magic number?
Well, the goal is to keep the fund's equity ratio at or above 1.3% of all insured shares. The trigger point, the line in the sand, was set at 1.23%.
So if it dips below 1.23%, alarms go off.
Pretty much. The board is then required by law to immediately charge all the credit unions a premium to bring that level back up, and we saw it happen. In 1991, the ratio dipped, and boom, the board charged the premium. It forces the industry to bear the cost of its own risks in real time.
At the same time all this is happening, the agency is dealing with big changes inside the credit union world itself, especially around this idea of the field of membership.
Oh, yeah. For decades, the rule was incredibly strict. You could only join a credit union if you had a very specific common bond, like you all worked for the same company or lived in the same small town.
That started to loosen up in the 80s.
It did. But the real earthquake came in 1998 with a law called the Credit Union Membership Access Act, H.R. 1151.
And that law,
Yeah,
it just changed everything.
it blew the doors open. Instead of being restricted to those tiny, narrow groups, credit unions could now serve much larger community-based or geographic areas. It was a massive expansion of their potential market.
Which they needed to compete with the big banks.
Absolutely. It was critical for letting them grow and achieve the scale they needed to survive. It was the moment the movement really became a nationwide competitor.
So that expansion helps them through the 90s and early 2000s, but then comes the big one, the global financial crisis of 2008.
Right. And it strained the entire system. The NCUA had to charge premiums again in 2009 and 2010. But the unique problem for credit unions, the real weak spot, wasn't the small consumer-facing CUs.
It was the ones that served them, the corporate credit unions.
Exactly. These were the giant wholesale institutions that provided banking services for the thousands of smaller credit unions. And 5 of the biggest ones in the country basically failed.
Here's where it gets really interesting for the listener. Why did they fail?
The same reason as so many big banks. They had invested billions and billions of dollars in those toxic, high-risk mortgage-backed securities that became worthless when the housing market collapsed.
So the failure of these huge central institutions threatened to take the whole system down with them.
It was an existential threat. And the NCUA had to act immediately to wall off the consumer system from these massive corporate losses, all while sticking to that core principle of no taxpayer bailouts.
And their response was, it was multi-pronged, it was complex.
It was a masterclass in crisis management. The first thing they did was work with the Treasury and Congress to create the Temporary Corporate Credit Union Stabilization Fund.
Okay, a stabilization fund. What was that for? Is that taxpayer money?
No. And that is the crucial point. It was designed to absorb the billions in losses from the failed corporates to protect the main NCUA insurance fund. But it was structured so that the credit unions themselves, not you, the taxpayer, would pay the costs back over time through special assessments.
So they contained the fire within their own house.
Precisely. Second, they got their hands dirty and dealt with the toxic assets themselves.
Ow!
They seized the failed corporates, and then they took all those worthless mortgage-backed securities, repackaged them, and sold them off with a new government-backed guarantee. That move alone raised almost $30 billion and helped stabilize the market.
And they had to keep the system running day to day.
Yes, so they set up these temporary bridge corporate credit unions. These were placeholder institutions run by the NCUA to make sure that consumer CUs could still clear payments and get liquidity while the old corporates were being dismantled. It prevented any disruption for those 124 million members.
And beyond the corporate mess, they also had to deal with regular consumer-owned credit unions failing because of foreclosures and unemployment.
Right, and their response there was to get much tougher on supervision. They implemented a mandatory 12-month examination cycle for every single federally insured credit union.
To catch problems faster.
Much faster, before they could fester and lead to insolvency. And you know what? It worked. The data is incredible. By the end of 2009, in the middle of the worst financial crisis since the Depression, over 96% of all credit unions were still considered well-capitalized. It was a remarkable success story of self-funded crisis containment.
So coming out of the '08 crisis, the next decade seems to be about making things permanent, really cementing the lessons they learned.
Absolutely. The first big step was the Dodd-Frank Act in 2010. That's the huge legislative response to the crisis. And it made the NCUA's $250,000 insurance limit permanent.
That had been a temporary increase during the crisis, right?
It had. Making it permanent was a huge deal for consumer confidence and stability. That's the guarantee you see on the little NCUA sign at every credit union.
And that legal battle we mentioned earlier over who credit unions could serve their field of membership, That fight continued to rage through this period.
It was a decade-long war, really. The NCUA issued new, broader rules in 2016 to modernize the system, and they were immediately sued by banking trade groups who said they were straying too far from the original mission.
But in the end, the NCUA won.
A huge regulatory victory. In 2019, the D.C. Circuit Court upheld most of their new rules. And then in 2020, the Supreme Court refused to hear an appeal from the banks. That was the final word. It cemented the broader membership criteria and really secured the future competitiveness of the credit union system.
And it's kind of amazing, just as they finally get that long-sought permanence, they get hit with a totally different kind of global crisis.
COVID-19. It's almost ironic. The agency celebrated its 50th anniversary as an independent regulator on March 10th, 2020. And then days later, the world just shut down.
And the response had to be immediate.
It was. They shifted gears instantly to focus on giving credit unions maximum flexibility to deal with the lockdowns, the loan distress, everything.
And that central liquidity facility, the CLF, became a key tool again.
Oh, it was the focal point. They took the lessons from 2008 and supercharged it. The CARES Act and the NCUA board made changes that dramatically increased the CLF's borrowing capacity and made it easier for more credit unions to join. They were preparing for a worst-case scenario, making sure a liquidity crunch wouldn't cause a system failure.
And they also used their community development fund to target help where it was needed most.
They did. They recognized that the pandemic was hitting low-income and underserved communities the hardest, so they dedicated the majority of the 2020 Community Development Revolving Loan Fund to COVID-19 assistance. It was a very mission-driven response.
Which brings us to today and where the NCUA is headed. The sources show the agency expanding its vision way beyond just insuring deposits.
It's a profound shift. They're looking at major macroeconomic and societal challenges and seeing how they connect to financial stability. A big one is advancing economic equity and justice.
What does that mean in practice?
It means using their regulatory power to help close the wealth gap. It means stricter compliance with fair lending laws and focusing examinations on whether institutions are actually serving their entire communities.
And they're also specifically supporting minority depository institutions, MDIs.
Right. They see that these MDIs are often the only gateway to financial services in some communities, so they're making their stability and growth a strategic priority. It's all part of that broader equity goal.
But the most surprising, I think, and maybe the most forward-looking expansion of their mandate is thinking about climate change.
What's fascinating here is you have a regulator that was born in 1934 to promote basic thrift, and now it's making strategic plans for rising sea levels and wildfires.
That's a huge leap.
It is. But the NCUA now recognizes that climate change is a direct threat to the solvency of regional credit unions. If you're a credit union in Florida or California, your entire loan portfolio could be exposed to hurricanes, floods, or fires.
So they're saying climate risk is financial risk.
Unquestionably. A major wildfire doesn't just destroy homes. It destabilizes the regional economy. It causes loan defaults. It devalues assets. All of that ultimately threatens the insurance fund they're sworn to protect. So they are moving into this next frontier of risk management, trying to figure out how to regulate for threats that are completely new. Hashtag #TagTagAttratrade.
So we've covered a lot of ground here, from a small New Deal bureau to a $2 trillion regulator. The NCUA really stands as this essential but often overlooked pillar of U.S. financial stability.
I think the key takeaways are these. The NCUA protects the money of 124 million people. It's separate from the FDIC. Its leadership structure is built for bipartisan stability. And most importantly, its insurance fund is paid for by the credit unions themselves,
which allowed it to absorb the catastrophic losses of 2008 without a taxpayer bailout.
a critical point.
So what does this all mean? It means a huge part of our financial system is overseen by an agency that's not just an insurer. It's an agency that's deeply rooted in a cooperative, community-focused mission.
And that mission is now expanding to include promoting economic equity and even planning for the financial risks of climate change. It's a powerful, highly adaptive regulator.
We saw how the 2008 crisis came from risks in complex financial products, mortgage-backed securities. It was a threat they learned to manage. So here is a final provocative thought for you to explore on your own. With the NCUA now officially considering the risks from rising temperatures and devastating wildfires, What new unprecedented threats will these physical environmental changes create? Think about the loan portfolios in coastal Florida or agricultural California. Will that kind of concentrated climate risk force the NCUA to evolve the fail-safe features of its insurance fund into something we've never seen before, something beyond what they needed for the crises of the 80s or 2008? How do you price the risk of a flood or a fire into the stability of a cooperative system?
Thanks for joining us for the deep dive.
We'll catch you next time.